Right, are we live? Are we good?
We're good.
Oh man, welcome everybody. I'm thrilled that we're doing this. This is fantastic. Listen, we have the ability to kind of go live when we've got something to say. And I think that it's important for all of us as investors, traders of any kind, really, to take a step back at the end of the month. Let's take a step back, take a deep breath. At the end of the quarter, even more so, right? Let's look at the data. Let's see what happened, right? And the beauty of technical analysis, and I found myself saying this a few times over the last few days, is that it's not just lines on a chart. That's not what it's about. It's about the visualization of what's actually happening, right? It's not about what could happen, what might happen, what should happen. This is what is actually happening, right? We know that. This is fact. You might not like it. You might have thought that something else was going to happen. Like, yeah, me too. But this is what's actually happening. And I have found over the years that it is incredibly advantageous to take what's actually happening seriously. you know, why do we want to take it so seriously? Because we don't know many things in this market. There's a lot of unknowns. But what do we know for a fact? We know that asset prices trend. We know. So let's look for those trends. Let's look for those trends. So I got 5 charts. I couldn't help myself. I got a couple more. You know how I roll. I got 5 charts for you. Uh, I think that these really tell the story going into Q4. We have what happened in the last 3 quarters. We have what happened the year before that, and so on. And all we can do is weigh all the evidence responsibly with an open mind and make the best decisions we can with the information that we have that we know is incomplete. We know, right? And a great way to think that I can do that is by analyzing trends. Let's go. Chart number 1 here. How can it not be? The S&P 500 on an equally weighted basis just closed at the highest levels for a month ever in human history. And so did the equally weighted NASDAQ 100 on an equally weighted basis. Both of these just closed at new all-time highs again. And all of these new all-time highs over the last several months have taken place all above the prior cycle's highs. All of them. So if the weight of the evidence is suggesting that now that demand has overwhelmed any supply for these assets at these prices, because there was obviously an overwhelming amount of supply relative to demand last time we were here in 2021, early 22, the market is proving, as it's continuing to make new highs in price, is that demand has absorbed that supply and prices can now move higher. Higher highs is a characteristic of a healthy market environment. New all-time highs is the most bullish thing that an asset can do. It's just math. We know. We know. We have the data. Asset prices trend. If you are constantly trying to fight these trends, yeah, you might get some right. We fight some trends sometimes, but you better be sure, because the probability is very much against us if we're doing that, right? It's against you if you're constantly fighting trends while being in the direction of trend. We know we're the house, right? We have the odds are on our favor, right? I like that. I like being the house. I don't want to be the sucker. I want to be the house. So we know that these are not downtrends. When you think about uptrends, when you think about bull markets, what we want to do is reverse engineer what those things look like. What do they look like? What happens in bull markets? I went to a birthday party the other day. Random, 42nd birthday, I think, 41st birthday. We took a party bus for no reason. Party bus. Okay. That doesn't happen in bear markets, right? New all-time highs on an equally weighted basis, S&P and NASDAQ 100. Does that happen in bear markets? No, not so much. No. By the way, the equally weighted indexes are great, but we live in a market cap weighted world. I know that bothers some people, like, oh, the big get bigger, blah, blah, blah. Well, that's just the way it is. We live in a market cap weighted world. Fun fact, the market cap weighted S&P 500 and market cap weighted NASDAQ 100 also closed the month at new all-time highs. Both of them. This is in a quarter where technology was down. Technology was down in Q3, not up. Yet, despite all of that, The market cap weighted S&P 500, which is essentially 1/3 technology, still made a new all-time high. And the NASDAQ 100 market cap, which is half technology, 50%, also made new all-time highs. So, you know, that's how I see that. Chart number 1. Chart number 2. Guys, I skipped the chart there. Yeah, you got it, Spencer. Chart number 2. Mathematically, you cannot have a bear market or a downtrend or correction of any kind without the prices of stocks falling. Fact. I'll give you my opinion. I'll tell you what I think is going to happen. I'll tell you that I like the ribeye better than the filet. Oh, I like the Bordeaux better than the Burgundy. Yeah, I can tell you all that. But you can't have a bear market or correction of any kind without the prices of stocks falling. Fact. So if we know that, shouldn't we spend some time looking and counting at how many stocks are falling in price? I think so. And as it turns out, there aren't many at all that are falling in price. That's why bull market, no new lows. Like that's what happens in bull markets. You don't get stocks going down in price. Right? These are very I feel like these are very elementary, very common sense concepts that just don't get talked about as much. Like, yeah, duh, you need stocks going down. So we're looking at the 1 month lows. I think it's a great place to start. If we start to see a spike in new 1 month lows, maybe the most amount of new 1 month lows than we've seen in 18 months, 2 years, something like that, something that stands out. Fine. Stocks are going down in price in that scenario. That is not what's happening here. So I laid out some lines there. We're looking at the new 1 month lows for the S&P 500, S&P 400 mid caps, and S&P 600 small caps all the way at the bottom. We are just making just a normal amount of lows, just nothing, right? Nothing's really going on there. If you start to see a spike above those levels, now you could say, hey, JC, look, there are stocks that are falling in price. Perhaps this is the beginning of a correction, perhaps. And we will cross that bridge when we get to it, and we have not. So the next chart there shows the 3 month lows, right? So again, not much happening there. If we were to get a spike in new 3 month lows, so it's about a quarter here. More stocks in the S&P 500 making new lows, making new 3 month lows, more so than we've seen in a couple of years. Fine. That would be evidence that there are stocks that are falling in price, right? And I appreciate you guys. Wall Street, the chat works. Love you guys. Kane, happy to be here. UK in the building. What's up? And then I just wanted to reiterate why the new 52-week lows is not really helpful right now. If you go to the next chart there, you'll see that the new 52-week lows is non-existent. Non-existent. These are the new 12-month lows. There's nothing happening here. So if we're going to wait for the new 12-month lows to spike, that's a little bit later in the cycle. Like, let's get 1 month lows, 3 month lows, and then we can talk about 52-week lows, right? Corrections are a process. It takes time. I'm telling you, if stocks are going down, you're going to see it in the new 1 month lows list. You're going to see it in the new 3 month lows list. You're going to see it. It's just math, right? So chart number 3, again, watch the new 1 month lows. I would argue chart 2B would be the 3 month lows, and you can ignore the new 52-week lows for the foreseeable future until those other ones start to act up. Okay, chart number 3. Numero 3. Billy Cunningham, what's up? Chart number 3. Energy. In technical analysis kindergarten, in like week 2 after recess, you know what you learn? You learn that former resistance tends to turn into support, where there was an overwhelming amount of supply relative to demand. Ultimately, when prices exceed those levels, what are you going to see? You're going to see that demand exceeding that supply at those same levels. Where there were more sellers, become more buyers. That's just supply and demand 101. Well, we're seeing it as we're recording this. The crude oil futures are up 5% on the day. Boku Dolores, right? And what's happening is that former resistance, and not just in crude oil, which is why I want to see I cheat around here. I'm like, I got 5 charts. I'm already at number 10 already or something like that, right? What can I tell you? 5 charts. Keep it simple, stupid. But the reason I wanted to show all 3 here, crude oil, heating oil, and unleaded gasoline, is because it's the same story. It's the same story. It's energy in general. It's not just crude oil. It's the whole energy complex. And I think that speaks to that. So going into the fourth quarter, what I think are the five most important charts, and I've been thinking about it. And I asked Straza, and I asked the team, I'm like, what are you guys thinking? Da da da. You know, this has to be in the conversation. Energy stocks have been out of favor. Crude oil has struggled. Natural gas has already been getting going. Some pretty great trades for us, no question. But now you're seeing it in energy. And when you look at ExxonMobil, I should have brought my ExxonMobil chart. If you look at ExxonMobil, I mean, pushing up against new all-time highs, that's not nothing. I think that ExxonMobil might be saying something, because if you're going to buy one of these energy stocks, and I got it here, Spencer, if you want to throw up the new next slide, if you want to just recap that. I threw in the ExxonMobil chart just because we can. We have the technology. Here you go. Let's see the Exxon chart. What we're seeing in the Exxon chart is just a massive base going back to the great financial crisis. And we are above those levels. In a weak energy tape with oil pushing down near lows until the last week or so, right? So I think this was a big one to watch. The relative strength in such a bellwether like ExxonMobil is telling for sure. We look at a lot of these bellwethers, like a JP Morgan for financials, right? As almost like indexes in and of themselves, Microsoft for technology, things like that, right? All right. Number 4, and this kind of plays into this energy situation, is the United States dollar, which of course has acted as a as a defensive trade. This is the defensive trade. It hasn't been bonds. It hasn't been yen, right? Yen's kind of been in its own thing. It's been the dollar. That's really what it's been. And as money has flown into risk assets, particularly stocks, you've seen money coming out of the dollar. You just saw emerging market currencies making new 3-month highs. The emerging market currencies index, which is 14 equally weighted emerging market Forex crosses, making new 3-year highs and reaching overbought conditions and momentum, by the way, which is what happens in strong uptrends. And this includes like the worst of the worst, the Polish zloty and the Mexican peso and the real. And I mean, just terrible emerging market currencies making new 3-year highs as the Korean won makes its move, and the Thai baht and the Philippine peso. These things have been working. That's evidence of risk appetite. Now, if the United States dollar index here were to start to find some support, where it has in the past over the last couple of years, I might add, I think that would put pressure in equities. And I think that would suggest higher energy prices because of the relationship that the dollar has had with energy, which has been pretty consistently positive. And now that you've been seeing a little bit of a bid in the dollar over the last week, have you not seen it in energy also? So there's a really interesting relationship between energy and the dollar in general with risk assets. So I think it would be, we talk about stocks and we talk about trading options, and yes, but let's not forget that all of that falls within the context of the top-down global macro analysis that we're doing, to help decide whether it's a risk on environment, or perhaps some risk aversion is needed, and some more defensive rotation. And we're just not seeing that defensive rotation yet. Utilities are a leader. Yeah, utilities did great this year. They did great last quarter also. Industrials, financials, and consumer discretionary were all up double digits last quarter. So you can't tell me it was defensive rotation if you got consumer discretionaries, financials, and industrials all up double digits. Utilities are stocks. They go up in bull markets too. I would argue maybe it's more of an interest rate thing. Chart number 5. I don't see people talking about this one, guys. I don't see people talking about it. For me, it really stands out. At the top, we're looking at technology relative to the S&P 500. So these are tech stocks, large cap tech stocks relative to the S&P 500, which is a large cap index of stocks, 500 of them, approximately 503, because Google's fancy and Berkshire and the whole thing. 500 stocks. So technology relative to the market cap weighted S&P 500. And below, you've got the S&P small cap technology index relative to the S&P 600 small cap index as a whole, of which technology is one of the larger representatives. And of course, in the large cap space, technology is the largest representative. Small cap technology has been underperforming for over a year, right? on a relative basis peaked last year, right? And has been falling. So the back half of last year, as you can see in that blue line here, that back half of last year, so that gray line up and down separates last year and this year. So on the left side, you'll notice that small cap technology had already been underperforming the back half of last year, while large cap technology was still an outperformer going into year end. Small cap technology has continued its downtrend and underperformance this year, as it started in the back half of last year. And now large cap technology has been underperforming as well, to the point where, great returns in the third quarter. For stocks, technology was actually down. Small cap technology is down 3% this year, in a great year for stocks, right? Large cap tech's up 15, which is a dramatic underperformer, but small cap tech is down on an absolute basis. So when I see things like that in a bull market, where technology historically is an outperformer and a leader in a bull market, almost every bull market has technology as an outperformer. I look to see which tech stocks are outperforming, which is why I wanted to bring this here. I know I said I'd bring 5 charts, but I want you guys to see the process. I want to see which tech stocks are bucking the trend. Can you throw that one up, Spencer, please? Which tech stocks are bucking the trend? So we create a technology leadership scan, right? Anybody, any country is welcome. Anything above $1 billion, because if you're below $1 billion in market cap, you're useless to me. Like $1 billion, come on, get your act together. I want $1 billion company plus. As long as it trades on the U.S., I don't care if it's from China, Israel, Canada, don't matter to me one bit. So as you can see here, we do have some Chinese technology companies. We've got some Canadian technology companies, right? A lot of American technology companies, obviously. I want to know which tech stocks are bucking the trend. I want to own those. Because if and when tech comes back into favor, who do you think are going to be the leaders to the upside? The ones that have been working while tech in general was under pressure, right? That's how I look at it. So guys, this is what we do at All Star Charts. And yesterday was a very special day. If you want to throw up some of the bullets of what premium members of All Star Charts receive, yesterday was our monthly chart strategy session, which we do at the beginning of every month. And in this case, at the beginning of the quarter too. So you got a double whammy, a lot of data coming in. That was fantastic. We do this twice a month. Once at the beginning, we've got about 130 charts. We sit there for about an hour going through the biggest trends, going over the best trades. We had 10 biotech stocks in yesterday's conference call. 10. That's twice as much as any other conference call in the history of All-Star Charts. And we've been doing this for 10 years, right? 10 years now? Wow. Yeah, conference calls maybe 9, but we've been doing it for 10 years. Wow. Never. Biotech stand out. There's opportunities in energy. I brought 3 energy stocks that you got to see. I brought a nice gold stock for you gold folks. And then, of course, there are some technology stocks, some industrials that stand out that I think we need to buy right now. So as a member of All-Star Charts Premium, not only are you getting the conference calls, you're getting all the trade ideas. You have 24/7 access to all the trades that come out. Stocks, ETFs, doesn't matter. Longer term trades, shorter term trades, intermediate. We define the time horizon with each of those opportunities. Then, of course, you get the technical analysis bootcamp that we just put together, which is fantastic. All the basic principles of technical analysis and what you need to know. And, of course, direct access to myself and the rest of the team. Guys, Spencer, if you could throw that up there. So I don't think we've ever done this. We're doing a $349 for the month as a member of All Star Charts Premium. That's great. So $349 for the month. We're doing $599 quarterly. That's a great deal. So you get access to all of the research, all of the trade ideas, 2 conference calls, the boot camp, and of course, Spencer Israel. I have to mention the 12-week mastermind that we've put together, in which week 1 was just a tremendous success about finding who you are as an investor, what you're doing here, what your objectives are, what your time horizon is. And we had to bring a financial advisors, so we sit down, I sit down 35, 40 minutes, and then we invite some additional guests throughout the week. In this case, we're looking at Stephen Weitzel, who came on. He's a financial advisor, manages over $1 billion in assets, answers these questions, helps clients walk through these. So this particular session, he's speaking to other financial advisors. We have a lot of financial advisors that come to us for our research. But in addition to that, he speaks to those of us that are not financial advisors, right? We're not that good at that stuff. So he is. Also, Dr. Pearl Dog came through talking about, so this is only for premium members of All Star Charts. This is part of week one of our 12-week mastermind. We are now in week two, which is all about momentum and how to profit from momentum and how we use it. But this is all part of week one that you receive as a member of All Star Charts Premium. Dr. Phil Perlman, I mean, listen, if we're going to make decisions, trying to make the best decisions possible with incomplete information, putting our minds and bodies in the right place to make those decisions should prove advantageous. And Phil Perlman walks us through how we can do that as investors, traders, professionals, entrepreneurs in general. I think to have a week one to kick off the 12-week mastermind without Phil Perlman coming in to share some wisdom, I think would be foolish. And then, maybe my favorite lab of the week, Mr. Chris Kane, Charles Dow Award winner, head of quantitative strategy at Bloomberg Intelligence, which is a division of Bloomberg Research, talking about diversification. I hate to break it to you, but you're not diversified. You're not. You got your equities and you got your real estate, and then you got your trading, and then you own a bunch of stocks. I mean, I know there are people who have other things, but like just general, myself included. I am overexposed. I'm personally not diversified, but I will give myself credit. I've been going over time, adding different strategies to my portfolio in order to receive that diversification. Because people think diversification, oh, well, if I have too many different things, then I'm limiting my upside. So I don't want to do that. Like I know I'm limiting my downside because of diversification. I know, but I'm limiting. No, no, no. Having a series of strategies, 3 to 5 strategies that are unrelated to one another, not only lowers the volatility in the portfolio, but because it lowers the volatility of the portfolio, the returns compound faster over time, right? Think of it like that. Yes, you're getting lower volatility. You know that. But because of that, the returns compound over time. That's the key element. You're not sacrificing forward returns. It's actually the exact opposite. So just an incredible conversation about why you want to incorporate different strategies, whether they be different asset classes, or perhaps one is a trending sort of trend following system, while another one can be more of a mean reverting. Having different time horizons is also beneficial. But again, when you see the math, like the way he says it, like from a qualitative standpoint, we understand the benefits of diversification. But from a quantitative standpoint, just how important it is. Guys, as a member of the All Star Charts Premium, you get this 12-week mastermind. All of this is just from week one. So, we got a lot to cover. So, guys, I appreciate it. We looked at the 5 charts. Let's bang them out one more time. Spencer Israel, chart number 1, NASDAQ 100, equally weighted. S&P 500, equally weighted, making new all-time highs. If we're above those prior cycles highs, tough to be bearish. We got to be bullish. We got to spend our time looking for stocks to buy. We start breaking below that. Now we can have a different conversation. Chart number 2, Spencer Israel. We're looking at the new 1-month lows. Looking at the new, one more higher, but looking at the new 1-month lows. If we start to see an expansion in stocks making new 1-month lows, if you tell me, JC, we saw the most 1-month lows on the New York Stock Exchange, or the most new 1-month lows in the S&P 500 or Russell 3000 or any of those or all of the above, more new lows than we've seen in 2 years, JC. Most new lows since COVID. You start to tell me those things, that is literally mathematical evidence that the prices of stocks are falling. Without that, you can't make that argument. So I would look at that. Number 3, energy, former resistance turning into support, tough to ignore. If we're above those lows, you got to own energy. That's how I see it. You could fight that trend if you want. If we're below those lows, then no, fine, don't own energy. Above that, I think you got to own it. With that, look at the US dollar. If the dollar finds support here, expect pressure in markets. We got the volatility index above 20 right now with the dollar bouncing a little bit. Expect more of that. If the dollar is going to strengthen, the dollar rolls over here and starts to make new lows, that would be bullish for risk assets for sure. And then last but not least, technology underperforming for quite some time. This technology underperformance really stands out. It's a big sector. I think this is part of why sentiment is so pessimistic. We look at the data, we aggregate it all. I understand there might be one poll that's a little bit, on the bullish side, not even to that extreme, but just we aggregate all the sentiment. And you want to know the truth? We're somewhere in the middle. We're nowhere near bullishness, despite the fact that all these indexes keep making new all-time highs every month. The S&P, the NASDAQ, equally weighted, market cap weighted, the Dow, transports made 12-month highs, German DAX, right? All of these things keep making new all-time highs. Freaking China just had its best week in history. Nope. Nobody cares. Sentiment is still down in the dumps. And I think a lot of that has to do with the fact that technology stocks haven't been doing great, right? A lot of people own technology stocks. It's sort of like, what have you done for me lately? So I think that's part of the pessimism stems from the lack of technology. So the lack of technology performance. So that's why I like that next table that shows the ones that are bucking the trend. The technology stocks that are acting the best, those are the ones that we want to pay closer attention to. So guys, join me at All Star Charts Premium. Join myself and the team. I could speak from experience. I'd rather be, going to the market, looking for ideas, looking for opportunities, trying to make money, knowing that I have a team with me. I have Alfonso and Straza and Sean and Jason and Sam and Grant. Like, I know I got the team. Like, what do we need? Where do we find opportunities? Like, I'm confident rather than if I was just by myself in a silo. So if you're like me and you like being with a team, helping you find ideas and strategize, join me at All Star Charts Premium. I think it's a great deal. $349 for the month. Fantastic. $599 for the